Hey guys, it's Ehren, the Finley Mortgage team, and today we want to talk about loan to value on your purchase, how that's going to affect your rate and terms on the mortgage, and also how that affects your HELOC as well too. Firstly, starting off, loan to value is simply the amount of debt versus the down payment that you're going to get, or the amount of mortgage versus the down payment you're going to get. So there's a few different situations. If you're looking at putting less than 20% down on your property, so you're looking at a 80% or below type mortgage, you're going to be in an insured mortgage. So this mortgage is going to have to be backed by an insurer. So we're talking about CMHC, Sagan, or Canada Guarantee. On these higher loan to values or these high ratio mortgages, you're going to get the lowest interest rate on the market, but you're also going to get the lowest amortization on the market as well too. So we're talking a 25-year amortization versus a 30-year amortization. So what this means is you're actually spreading your mortgage payments out over less time. So your mortgage payments are actually going to be higher at that interest rate compared to a longer amortization. Now on these sub 20% down payments and these high ratio loan to values, you're also going to have insurance on there as well too. So you're going to have insurance premium from the mortgage insurer, and you're also going to have some insurance tax you're going to be paying at the time of closing. That insurance premium is going to be added to your mortgage, so you're going to have an increased mortgage, and that means you're also paying your monthly payment based off of that increased loan amount as well too. And that insurance tax, like I said, we can't amortize that out, so it is paid on closing. Now when you're looking at loan to values that are less than 80%, you're going to be in some sort of uninsured mortgage. So uninsured means you no longer have that insurance premium added to your mortgage. You have the ability to do an uninsured mortgage for a 25-year AM and a 30-year AM. Now most buyers are going to take that 30-year AM because it does reduce your payments per month, because you are spreading that out over an additional 5 years throughout your amortization. Now there are some lenders out there who can get really creative when you're sitting around that 65% loan to value. Some of these lenders have a special product, and again, they're able to extend your debt ratios, maybe be a little bit more flexible on the types of incomes and other incomes, supporting incomes that they can use on the file, and really stretch those debt ratios to help you get into a mortgage. So if you're really tight in your debt servicing and you're looking for a solution, having the ability to put 35% down can really help us get creative and find a way to get you into that property. Now, when we're looking at a private mortgage, you're still looking at that standard 25 to 20% down, so a 75 to 80% loan to value. Now if you're looking to do a mortgage that's 100% loan to value, it is something that is available on the private side, but for the majority of these types of projects, we're going to need some sort of collateral type property to help the lender feel secure and extend that loan to value to get you to 100% financing. That mortgage is then tagged on both properties. So we're going to have a first mortgage on your subject property and then perhaps a second mortgage on your collateral type property. Now when we're looking at home equity line of credits or HELOCs, we're really limited to 65% loan to value. Now that's not a lender thing, it's actually a federal mandate. The federal government doesn't allow you to extend that home equity line of credit past that 65% loan to value on your property. If you're able to have a mortgage on your property and then tag that HELOC on there as well too, but the amount of HELOC that you have in terms of that value can't be greater than 65% of your property value. Now there are some other unique types of products out there that act similar to a home equity line of credit, like the STEP product, where we are able to actually extend that up to 80%, but it is a different product entirely. So just make sure you want to reach out to us and ask any questions to get a better understanding. I hope this clears up some of the understanding around loan to values and how high you can get your HELOC to. As always, if you guys have any questions, please feel free to leave them down below in the chat or reach out to us directly with any specific situations you guys may have.